Shopify stock has been in free fall now below its pre-pandemic levels after reporting a huge profit miss. Investors have seen a nearly 50% drop in the last month and nearly 75% in the last 6 months. Investors are wondering, is this the bottom for Shopify stock? I'm going to talk about all this and more. If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. We're going to talk about what does Shopify do, why has the stock sold off so dramatically, and what do I think about the current valuation? Could this potentially be the bottom? We'll talk about all these different dynamics. If this is your first time tuning in, please make a point of hitting that thumbs up, hit that subscribe button. So let's dive right in to understand the business. So on a high level, Shopify provides critical functionality, critical infrastructure for merchants of all size, nano to mega merchants. And so it can be really anything from inventory and fulfillment, order management, shipping, helping effectively capital for a merchant, providing loans, marketing, analytics. Really, what they started off was providing help with online, infrastructure for businesses, and now they're rapidly growing to offering a lot of other key services, which we'll talk about in a second. But they clearly have one of the largest market shares, slices of the pie. Here's one chart suggesting that their share of e-commerce platform market share is over 30%, largest player if you're, not including Amazon. So they are clearly doing well. The question is, why is everyone panicking? And so a key aspect is just the normalization of e-commerce, where you can see e-commerce has grown as a percentage of retail sales over time. You saw this huge spike as people effectively had to shop online in response to COVID. Now that's normalizing. And so yes, management expects the long-term trend of e-commerce to keep growing. They did see a nice term benefit, but what you're doing here is you're sort of looking at a tough challenge of you grew so fast previously, and now you still have this long-term trend, but you're just not growing as fast. And that's instead of the 110% growth that they literally got last year, they only grew revenue 22% this year, which is still, for most companies, that's still quite satisfactory, representing a 2-year compound annual growth rate of 60%. So this is still exceptional growth territory. Investors were also disappointed to see that they swung from a sizable profit to a sizable loss as their growth didn't keep up with their expansion of expenses, investing in the business. Now, one of the things that they're doing to invest in the business is have omnichannel offerings, and their offline solutions grew 80%. So the volume of business offline grew 80%. That was powered by Shopify's different solutions. So that suggests they are taking share with this omnichannel approach, and their e-commerce market share is definitely continuing to take share, especially as you compare it to some of the other players out there like Wix, for example. They continue to take market share. And they continue to take market share partly because they continue to invest in their value proposition, making them arguably an unrivaled value for the merchants that decide to partner with them. They're expecting to launch Shop Promise, which is going to help consumers find 2-day and next-day delivery. So this is exactly what customers want, and ultimately this is what merchants are going to want as well. In order to make this possible, they're acquiring a company called Deliver. This is going to be the largest acquisition by Shopify, and this is going to help merchants of all sizes remove the complexity of supply chain from port to porch and across all sales channels. So this is enabling effectively key functionality, what customers expect, and helping a clear pain point for merchants in terms of getting those next day deliveries, next day shipments. And so the question is, what's the right value for Shopify? You've seen this huge drop, 75% drop. Will it keep going? Where's the rebound? Where's the bottom? First, a quick plug where if you're either struggling with this current investment environment or you want to find potential multi-baggers, go to unrivaledinvesting.com. And a big thank you to all the Unrivaled Investing subscribers that keep this channel alive. Without the Unrivaled Investing subscribers, there wouldn't be this channel. So if you enjoy this video, I hope you consider checking out Unrivaled Investing. So as we consider Shopify, it's first important to understand that yes, they are winning share. Yes, they're growing nicely, and they are reinvesting in their value proposition to keep growing share, to keep growing in the years ahead. But it's not without tough competition. Amazon recently released Buy with Prime, where you can get next day shipping, even if it's not on the Amazon.com site. So this is table stakes, effectively. You are going to be expected to deliver next day shipping, if you plan on competing online. These bets, the type of bets that Shopify is making, this acquisition of Deliver, these bets, this has dashed any sort of hope for near-term profitability. And when you look at a setup where you're saying, oh yeah, we saw your profitability last year and we were hoping this would be a trend, and you go, oh, this was only because you grew really fast last year. You grew faster than you yourself expected. Oh, that's a bummer. Like we were hoping to keep seeing profitability, and now saying, yeah, that's not going to happen. That should warrant a lower valuation. That should, that's a very rational response to the stock price. Now the question is, how much is too much, when you're looking at this. And so let's dive into a hypothetical framework for how we should consider, looking at Shopify stock. So as we look at this, currently it's around $50 billion valuation, trying to figure out where should this go from here. Maybe this growth this next year, keep in mind, they grew closer to 22%. In the first quarter. No one really knows. They're expecting to accelerate throughout the year, but who knows how that plays out? Maybe it's somewhere between 20 and 40% growth this next year. The question is, where does their long-term profitability shake out? They're currently unprofitable. Now, they do have 50% plus gross margins, so that could translate into optimized profitability long-term of maybe somewhere between 20 and 30%. Unclear how that plays out. They continue to have to make these bets to compete with the large players like Amazon that's offering these new services. And so even if you're not on Amazon.com, you can get that potentially that next day or shipping option. And so you're looking at this, and so I'm looking at a company that's effectively trading at 8 to 9 times forward sales. This isn't dirt cheap, but this is a really high quality business. This is winning market share, the top dog for helping independent merchants. And so I'm looking at this, seeing I'm penciling out 25 to 35% potential growth in the years ahead, and an N multiple of, let's say, 20 to 30 times. I slap on a 20% tax rate as I think about it, and 20 to 30 times N multiple 5 years from now. I try to have a reasonable range of what's the earnings multiple that you want to assume, assuming that they can even get to these profit margins, which might be, a bridge too far. We'll see. And so based on that, you're effectively penciling out 200% upside and effectively break even over the next 5 years if the stock stays effectively where it is. So at $387, if you have the low case scenario where they're able to achieve much higher profitability and 20 times earnings multiple, you're effectively break even over the next 5 years. But you do have this optionality where, hey, if they're growing closer to 35% annualized and you're looking at closer to 30% profit margins, investors might value it closer to 30 times earnings, in which case you're closer to 200% upside from here. Now, of course, this is a hypothetical framework, and full disclosure, I do own some Shopify stock. And look, the stock price can go way higher or lower, as you consider this. So what are my thoughts, from here? What do I think about Shopify stock? First of all, because it's fallen so quickly, so fast, it wouldn't surprise me to see a sharp rally in equities. You do get dead cat bounces. You do get these things where you have breathtaking rallies where things just shoot higher. Now, does that mean the ultimate bottom is in? I'm sort of skeptical. I'm looking at that valuation and I'm thinking, if there were to be a recession, which the odds increasingly, seem to be going higher, you're looking at that setup and saying, is it possible that in a recession, an unprofitable company with decelerating growth could get an even greater discounted valuation? So that is something that I'm mindful of. And in reality, I personally would prefer to own free cash flow machines, the type of companies that could take advantage of a weak stock price by buying back their shares. So that's what I personally prefer, because then, hey, you effectively get richer the longer the stock price stays low, because if you buy into that company, they're just gobbling up market share. So your effective ownership in that company is growing over time. So I look at this and I think the current price, it is a solid risk reward, effectively saying break even over the next 5 years and maybe a couple 100% upside. I do think that risk reward is better than, let's say, the S&P 500. So I do think that, upside potential is better than what you could get with owning a major index like the S&P 500. I think I would be more inclined to buy a bit lower, though. Not exactly sure. Maybe 350, maybe below 300. So we'll see. I'll keep the Unrivaled Investing subscribers apprised, if I do ultimately buy more. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.